I'm Yahoo Finance Executive Editor Brian Sozzi. You're taking a look at our live shot of the opening bells on Wall Street on this Tuesday morning. Healthcare provider Evolent ringing the bell at the New York Stock Exchange. Salmon's Retirement Solutions getting things underway over at the NASDAQ. This is New Yorkers and those on Wall Street monitor the latest updates following a shooting in Midtown Manhattan that claimed the lives of 4 innocent civilians. The National Football League commissioner said in a statement that one of its employees was seriously injured in the attack. The attack also claimed the life of an NYPD officer as well as an executive from Blackstone. We'll continue to bring you the latest updates as they cross the wires. Meanwhile, markets are taking their cue today from a mixed crop of earnings. UPS reported another stinker of a quarter. P&G warned on a $1 billion Trump tariff hit, and Spotify fell short of consensus on the top and bottom lines. Boeing managed to narrow its losses, with new CEO Kelly Ortberg beginning to tout a turnaround. Now, opening bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all of that money in your portfolio. Let's stay on the earnings parade and head down to the NASDAQ and check in with Yahoo Finance senior reporter Brooke DePalma. Brooke, speaking of ugly earnings reports, Whirlpool really laying an egg on its earnings release in large part because of tariffs.
Yeah, Whirlpool indeed. Stock now of Whirlpool down nearly 13%, down 12.5, rather, at the open in this early innings of today's trading session after the company warned that tariffs took a toll on consumer sentiment within the quarter. I know we'll talk more about that in just a bit, but taking a closer look at all 3 major indices, the Dow falling 0.01% as we make our way into the open. The NASDAQ holding on to that momentum, up 0.5%. The S&P 500 also holding on to that momentum as well, up 0.2%. And largely what we're seeing here is investors try to digest not only what we're hearing from Whirlpool and how that's affecting other key companies, like take, for example, Hamilton Beach Brands Holding Company. We're seeing that stock under pressure, down more than 7% this morning as they're trying to understand this impact of not only tariffs on these companies' supply chain, but also in terms of consumer sentiment. We also have a slew of data, economic data, that we're expecting out this morning when it comes to the consumer confidence report set to come out this morning, JOLTS, as well as the key jobs report on Friday morning, also expected to come out on top of the Federal Reserve meeting happening today and tomorrow, where they're largely expected to hold interest rates. And on top of that, Sozzi, once again, we have that NASDAQ still moving higher as we make our way into the opening, still holding on to that roughly 0.5% as we have Meta, Microsoft, Amazon, and Apple all expected to report this week.
I think I own something from Hamilton Beach, Brooke. I think it's a toaster. I'll circle back with you tomorrow on that one. Brooke, thanks so much. We'll see you in a second. All right, kick things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number 1, what happened to the great earnings season we were having? Spotify, Whirlpool, UPS, and others serve up lackluster earnings reports just as the market hit fresh records. In terms of question now is this: are investors too upbeat on the outlook for corporate America? Number 2, using less Tide Pods. One of those companies with a mixed quarter out today is Procter Gamble. The company beat earnings estimates but issued a weak profit outlook due to a $1 billion Trump tariff hit. P&G CEO John Moeller tells me consumers are trading down and he's pushing through price hikes. We'll have my full chat with Moeller coming up. Number 3, the Fed meeting kicks off today just as the U.S. dollar is on track for its best month of the year, and the Friday jobs report looms large. At this point, markets are expecting the Fed to stand pat on interest rates, but embattled Chair Jerome Powell could signal a cut is coming in the fall. Lots to get to here. And my roundtable is here to talk about all this stuff. Piper Sandler Chief Investment Strategist Michael Kantrowitz and Yahoo Finance Senior Reporters Brooke DePalma and Inez Ferre. Good to see you all. Michael, I want to start with you here. Big day for corporate earnings. And I look at the P&G earnings release calling out a $1 billion tariff hit this year to profits. I look at Stanley Black & Decker calling out an $800 million profit because of tariffs this year. Has the market just gotten too complacent on tariffs?
I don't think so. I think the issue is that you can't look at the market to assess whether or not a macro risk like tariffs is being reflected. Only when things become systemically risky do you see markets respond. But like those names you just highlighted, there are absolutely individual stocks that are at the center of tariffs that keep getting influenced by them. And we're seeing that in the earnings report. So the market may not be appearing to pay much respect to tariff risks, but individual names are. And of course, if we get some negative surprise from tariff deals or something out of Trump, perhaps it becomes a systemic risk, but that's certainly not the case today.
Mike, let me follow up on that. Outside the tariffs, you had a company like Spotify. Now, at first glance, they came out, had good things to say in terms of growth year over year on monthly active users and in many other parts of the portfolio, even free cash flow. That stock is getting hit. Is there a read-through there in terms of potential market froth?
I think if you disappoint in terms of guidance, especially in the wake of the last 4 months rally, where most stocks are up because we've priced out macro risk, so many stocks have seen, almost all stocks have seen some multiple expansion. If the earnings aren't good enough, yeah, there's a lot of downside risk, and that's what we've been highlighting to clients in this earnings season. Stocks that have gone up because of macro risk relief, not because of fundamental improvement. Those are at risk, in my opinion.
And as if there's any good thing to say here, it's that markets are not ignoring bad earnings reports.
Yeah, that's right. They're not ignoring these bad earnings reports. And you have to also look at where we're seeing some of the weakness with earnings. And that has to do with consumer staples, consumer discretionary. I mean, if we take a look at those two sectors, they are the laggards among the S&P 500 sectors. So you've got consumer staples that is up just a little bit more than 1%, but you've got the S&P 500 that's up more than 8%. So when you take a look at companies like Whirlpool, like P&G, they are being impacted by tariffs. And there seems to be a sort of bifurcation when it comes to the tariff with tariffs and how they're impacting bottom lines. And that is those that are focused on products for consumers, those Whirlpool that is bringing in a lot of their manufacturing to the U.S. It'll take time to see some of those benefits for the company. And then you've got other companies like big tech that is sort of immune to the tariff situation. So there is a sort of bifurcation, and you see it in the sectors that are leading these markets higher: industrial sector, tech, and then the ones that are lagging.
Brooke, and it's not just a tariff impact hitting the likes of Whirlpool and even a Stanley Black & Decker. There is a top-line component here as well, and a story to be told about more cautious consumers. Now, I asked P&G CEO John Moeller if he's seeing trade down in his portfolio. So in their case, it's premium product Tide, which we all love, but down to Gain. Now, we also love Gain, but it's a cheaper product. And he's telling me consumers are under pressure here.
Yes, certainly. That's been a trend that we've seen over these past few earnings reports, is that while the consumer here and there remains resilient, especially the low-income consumer remains under pressure. And they're largely being picky and choosy at large, all income cohorts. And that's certainly what we heard today. I was listening in to the Whirlpool earnings call this morning, and while they slashed their earnings outlook, the CEO said specifically, quote, the macroeconomic uncertainty marked by elevated interest rates and evolving trade policies negatively impact the consumer sentiment. He went on to say the weakness of consumer sentiment not only suppresses demand, but also impacted itself as we continue to see consumers choosing to mix into lower end products. Of course, Whirlpool behind very pricey products like those KitchenAid mixers as well. And so it's interesting as we have this sort of scenario where the housing market continues to struggle, mortgage rates remain high, consumers are saying, okay, what can I pull back on? What am I going to spend on here? And Whirlpool certainly feeling the impact of that. Once again, shares down more than 12% this morning at the open, are down now 10%.
Brooke, I've always wanted one of those KitchenAid mixers. I can't justify the price, at least in my use case. Like, I'm not baking cookies or bread, but it feels like I should just have one just sitting on my counter. Mike, I want to get back over to you. PE ratios for the S&P 500 trading at record highs, depending on how you want to look at things. How much longer do you think the market could continue to trade higher? Because like we're talking about this morning, the earnings are growing, but this is a market that is being driven more by momentum in terms of price.
Yeah, valuations are high. And I'll start by saying initially the valuation of the market, the S&P 500, should be high relative to history. You've got superior fundamentals. You've got really low real energy prices. Bond volatility is sitting at a multi-year low, and there's not much concern around tariffs, recession, inflation, or rates going higher. So both structurally and in the near term, that kind of makes sense. In terms of how much more PE expansion is possible, I think that's going to come down to ultimately the next several inflation reports and where interest rates go. And the risk, in my opinion, is that rates do grind higher. We get inflation numbers that are moderately higher, reflecting tariffs, and the market has to price out as many rate cuts as it's currently pricing in over the next 12 months. That's likely to cause not only PEs to at least stagnate, if not contract a little bit, but it's also likely to cause, I think, a sell-off in some of the most speculative names that have gone up in the last 3-4 months, again, on this macro relief trade. And one of the metrics I like to look at is corporate credit spreads. And those are back to basically the lowest levels in the last several decades. So that kind of suggests that the fuel for further PE expansion is nearing empty.
This is a masterclass you're giving essentially for free, Michael, on the PE ratio. But let me follow up here. Handicap this for us. Fed Chair Jerome Powell hops the mic tomorrow, talks about the decision likely that the Fed did not cut interest rates, but signals a rate cut could be in the cards for the fall. What's the market reaction, you think?
Well, I think that's what he has been signaling. So I don't think that would necessarily be a change. He keeps referring to the dot plot that obviously implies a rate cut or two. So the question, I think, will be, is anything going to be different? We really haven't gotten much new incremental news. Unemployment claims have come back down. The JOLTS data today, perhaps, if we get some big decline or big move the other way, perhaps he acknowledges that. And of course, we'll get payrolls on Friday. So nothing's really changed, in my opinion. And, President Trump continues to kick the can on China tariffs. And as long as we keep kicking the can on trade deals, I think it's going to make Powell more hesitant. So I don't think we'll hear anything new. Thus, I don't think we'll see much volatility coming out of the meeting.
Inez, tapping you in here, make sense of this for me. The dollar is on course for its best month of the year, 5-week high. Fidelity out this morning calling for gold prices at $3,000 an ounce. Normally, those two calls or those two moves don't go hand in hand.
Right, normally they don't, but we have seen that strengthening in the dollar recently. But if you take a look at year to date, we have seen a trend lower for the dollar. But Fidelity is saying 4,000 by the end of next year. Look, the Fed starts cutting, presumably in September. You do get some sort of a continued trend with the weaker dollar. And then you've got this tariff situation, which they're basically saying is a tax, right? So that would presumably be slowing the economy. So that is why you would see gold going higher. And this dovetails with Goldman Sachs also, which they believe that gold could, by the end of the year, per troy ounce, be at 3,700 by the end of the year. And by the middle of next year, you could see 4,000 an ounce. You've got some bearish calls, though. You've got Citi that is forecasting that you could see gold going lower by the end of the year because you have this risk of a recession that has been mitigated. And so therefore, you've got investors that are going into risk assets like equities, like what we've seen recently. But Fidelity out there with this call, and that dovetails with what some other analysts are also saying about gold. It is still you still have structural demand from central banks that have been pouring into gold, and you also have inflows into these ETF gold funds as well. Inez,
you own any of those Costco gold bars? They were a hot buy earlier in the year.
I know, I couldn't get any of them because they were, you can't even, by the time you got there, they were gone. So yeah, no, I don't own any of those.
Always have to ask about disclosures. All right, thank you to my contributors today. Straight ahead, it's a big day for Starbucks and CEO Brian Niccol. More on this when we return. Welcome back to Opening Bid. I'm watching Starbucks ahead of its earnings after the close today. You can feel the nervousness in the stock price as shares haven't really participated in this summer market rally, with the stock only up 1.6% in the past month. Here's what I'm looking for from Starbucks this evening. One, how close are they to selling a portion of their struggling China business? This has to happen. We got to get details. Two, is the sales story as cautious as we heard from Chipotle last week? Market did not like that Chipotle report. And three, what's the next important initiative from CEO Brian Niccol? For the stock to work higher, we'll need positive commentary on all three of these fronts. Tune into Opening Bid tomorrow when we sit down with Starbucks CEO Brian Niccol live. All right, staying on the CEO parade, Procter Gamble shares edging lower after the company topped earnings estimates in its fourth fiscal quarter, but it did warn of a $1 billion tariff hit and more cautious consumers. I sat down with Chairman and CEO John Moeller to discuss the quarter as well as his decision to step down at the end of the year.
Well, as of January 1st, when I step into the executive chair role, I will have served this company for 38 years. My wife also worked here as a senior executive until she retired when I became CEO. And between the two of us, we've served for 7 decades, or almost 3/4 of a century. We've, over the last period of time, if you look at the last 7 years since we implemented our strategy, results have been very strong. Organic sales, or sales, up $17.5 billion over that period of time, 84th percentile of the S&P 500. Profit up $6 billion, 92nd percentile of the S&P 500. $180 billion in incremental market cap, which is more value creation over that 7 years than all but one of our competitors have created over their 1 and 2 century histories. The team has created the 18th most valuable publicly traded company in the US, the 21st most valuable in the world. And on the back of those results, I feel very comfortable handing over the reins to a fantastic leader, Shailesh Jejurikar, who I've worked with for decades. He and I worked very closely recently. He was the COO of the company. I was the CEO. And so it just seems, as the calendar year passes, like a good time to pass the baton to the leader of the next phase of growth and value creation for the company.
When I look at your portfolio, John, I see Tide. Tide, I think premium product. Then I see Gain, solid product. I've used it in the past, but maybe priced a little bit cheaper than a Tide. Are you seeing that trade down from consumers?
We are seeing modest trade down within our branded portfolio. So within the different Tide offerings, there are some that are more premium than others, and we are seeing some trade down there. We're also seeing some trade down to brands that you mentioned, like Gain. We are not seeing any trade down as of yet to private label. Private label shares in both North America and Europe are down if you look at the last 12 months or even more recent periods. So consumers continue to understand the value that's contributed by performance. Remember, when we did that big portfolio consolidation that you talked about, there were 2 strategic objectives associated with that. One is to concentrate our portfolio in categories that were used daily, or even more than once a day by consumers. The second was to concentrate our portfolio into categories where performance drives brand choice. And that's held up extraordinarily well and puts us in a much better place as we move forward. I mentioned there is some trade down within the portfolio, but there also is continued trade up. And we find that whenever we can bring stronger performance that enhances relevancy for consumers and increases value, good things happen, and we have a big year of innovation ahead of us.
$1 billion tariff hit P&G is calling out for its new fiscal year. That's a very large number, I have to tell you that. But within that number, are you taking price increases to offset that type of hit?
There will be some price increases, and I think I mentioned that last quarter. Though we're going to try to combine those, as I just described, with innovation, so that the total value proposition to consumers, the benefit they think they're receiving for that slightly higher outlay is accretive. So you will see some increases over time. We're also working hard, as I mentioned earlier in our discussion, to reduce costs to minimize the impact of those price increases, but there will be some.
Lastly, John, the trade situation has cooled down just a touch, I would argue, compared to when I last talked to you. This $1 billion hit, is this a worst case scenario and we might see less of hit moving forward and perhaps less inflation as a result of these tariffs?
We've tried to be as reasonable as we can be, given the current information that we have and the current state of discussions around the world in our forecast of the tariffs. So they could go, frankly, either way at this point. Look, I want to step back on this. We understandably get kind of focused on single variables within the broad economic equation. and then I'll come back to tariffs. But if I look at the level of dialogue and openness on the part of the administration, the Hill, I've never seen it as productive as it is now. So there are ongoing discussions, two-way discussions all the time with policymakers trying to understand what the right path forward is. And in my view, on the corporate tax front, they got it precisely right with the growth incentives that are built into the most recent bill. We've made progress on, as you indicate, on the state of tariffs and how they're applied. And I have confidence that we'll continue to move in the right direction. The biggest thing for us is tariffs on naturally sourced ingredients that don't have a U.S. substitute. So, for example, psyllium is the active product. The husk of the psyllium seed is the active product in Metamucil, which we produce 100% of the world's supply in a plant in Arizona. You can't grow psyllium, I think we talked this last time, in the U.S. climate. And so by imposing a tariff on that and other naturally sourced materials that don't have a domestic alternative, you incent companies to potentially move production out of the U.S., which isn't what anybody wants. And we're fully supportive of the direction to try to enhance the environment for U.S. manufacturing. So those are some details that need to be worked through, but I feel comfortable the collective we are making progress in that regard.
John, real quick follow-up. Do you view tariffs as inflationary? I mean, you're calling out this big $1 billion hit, and you're taking some price increases in the portfolio. I mean, where do you stand on this one?
That's become a bad word, but I won't avoid it because of that. It is inherently inflationary. It increases the cost of importation. And that's part of the policy design. And in some places that makes a lot of sense. But it inherently increases cost. And then, manufacturers need to work through how much of that they can absorb and deal with and how much they need to pass on.
Coming up, Yahoo Finance's Market Catalyst. We bring you the news behind the market moves of the trading day. Do stick around.